in 2020 and 2021, we did the same thing on the upside. We never had a market double off the low as fast as it did. So obviously, there's a bit of a whipsaw effect. And I wonder what the indicators are telling you in terms of how the real economy is going to perform through this when it comes to things like consumers having more of a cushion than they have in the past. You look at things like the senior loan survey and whether, in fact, banks are willing to finance growth from here. How does that shake out at this point?
Mike, I really think we have to separate the economy and the market. But again, it goes back to what is the Fed going to do from here, right? They're raising interest rates. In 2020, my mistake coming up, I think we did a good job of looking at the low on all the extremes like we had in June of this year. And then I kept calling for a retest initially, even though, and what caused us to shift from there was when the Fed announced they were buying high-yield corporate debt on April 9th. We called it a game-changing decision. But by then, the market had ripped, so I was wrong at that point. It's different we've had this call for the fall since really the early spring, because the Fed is still raising rates, and that's the difference on a test. When you look at a test of the low, to me, again, any momentum shift, I am respectful of the market momentum. Any momentum shift, however, where it was a sustainable low and a real V bottom, every time I could find it, it came with an E, not just a Fed that stopped raising rates as much, but an actual easier Fed. So we're in between here.
Yeah, we are actually making new lows here for the session, down more than 900 on the Dow, more than 3% on the S&P 500. So down below those kind of previous August lows in the S&P that we had been watching for a bit, down 3.7% on the NASDAQ. So, Tony, in terms of the what do you do question, what's your best guidance on that score?
Mike,
in terms of sectors, in terms of types of stocks?
People keep expecting, because I was bullish for so long, right? I was the mega bull, right? But here's the problem. It's all about money availability. And people forget that back in the 2007, 2008, 2009 period, or even the 2001, 2, and 3 period, liquidity really shrank. And that's really ultimately the driver for stocks is the direction of earnings. That's driven by economic activity, and that's driven by money availability. Now, again, what do? People like me are famous for coming on here and telling you exactly what to do with high conviction. You don't have to do anything. Like my dad used to come down to the basement and look at my brother and me and say, don't just sit there, do something. All year I've been suggesting, don't just do something, sit there. If you don't have a high conviction level, that's when we get whipsawed. And I don't. I have a market momentum that's telling me you can't bet against it. And I got a fundamental backdrop that tells me you don't want to add to it until you go back and at least retest that low. So that's been our framework for months. I really don't see any reason to change it and make a big bet given the backdrop that we have.
We have we have a jobs number coming on Friday, CPI number the week after that, and then the Fed meeting. So we're looking at 3+ weeks when it seems as if the market is going to have this intense focal point on one place and probably will react to it there. You have a September seasonal weakness, midterm election patterns, maybe there's a little difference there. Is there any way to sort of say what to look for to know if the market has overshot or given you some kind of signal that things might be firming up?
So the great philosopher Mike Tyson said everybody's got a plan until you get punched in the face, right? So every time I look back at interest rates when they're spiking and when the Fed is really tight, they end up easing pretty quickly. The data point that I'm really focused on here, Mike, is the unemployment rate. Remember, the core PCE, for some god unknown reason, the Fed has let the narrative be about the CPI. The core PCE, which they've stated in the past they use because its weightings are better and more even, that peaked a few months ago. So we know that inflation is getting a little bit better. It's not where they want it to be. Today's message was clear by Fed Chair Powell. But I think the real thing that's going to be the kicker of when they're going to not just stop tightening rates, but ease more quickly than people think, is when the unemployment rate starts to go up. And in our view, that's going to be by the end of the year. Because if you look at the National Federation of Independent Business, Small Business Hiring Plans Index, it leads the unemployment rate by 4 months. And we're coming to the point where it should pivot. So I don't know if it's August or September, but ultimately I'm watching the unemployment rate more specifically. Because like I said, when the economy starts to really punch you in the face in an election year and the markets are weak, I don't know how hawkish they're going to